Welcome to Sky High Inflation is just one reason to hold physical gold. It appears that most market observers expect sky high inflation to be a temporary phenomenon, that it will sooner or later slow down again, especially as the world's major central banks have started tightening monetary policy. But is such an expectation really justified? Central banks in most countries have the mandate to keep consumer goods price inflation low, at a rate of around 2% per annum. And this is indeed what most central banks have achieved in recent years. Against this backdrop, it is not surprising that many people expect the currently very high inflation rates to come down again. But that seems a bit naive. To explain, let us take a closer look at the latest inflation numbers. Official data have been strongly affected by special factors, namely the increased scarcity of goods as a result of the politically dictated lockdowns, the drastic increase in energy prices due to green policies, and moreover higher goods prices due to Russia's war on Ukraine. These demand pull and cost push effects have significantly driven up consumer goods prices. No less importantly, central banks have created a huge monetary overhang in recent years that allows the latest goods price increases to translate into inflation, that is, sustained sharp rises in the prices of goods and services across the board. From this point of view, it is fair to say that inflation is a monetary phenomenon, because without the huge monetary overhang created by central banks, demand pull and cost push effects simply could not ignite a sustained increase in all goods prices over time. Inflation is not a natural disaster, it is man-made, and it is important to note in this context that central banks have been pursuing very inflationary monetary policies in recent years, established well before the lockdown crises, which admittedly triggered a very wild new round of money printing. The reason for this was the worsening debt problem. To sustain ever higher levels of debt accumulated by consumers, companies and governments in particular, ever lower interest rates are required. To prevent the debt pyramid from collapsing, governments and their central banks resort to financial repression. The central banks keep nominal interest rates well below the inflation rate, thereby making real interest rates negative. As a result, debtors enjoy most generous borrowing costs, while creditors and money holders get the short end of the stick. High inflation is particularly helpful for financially overstretched governments, as they can pay back less money in real terms than they have borrowed. However, financial repression accompanied by sky-high inflation is difficult to handle, even explosive. Sky-high inflation hurts the vast majority of the population. Once people see the monetary scam, the situation can quickly get ugly. It may all too easily result in social unrest, violence in the street, political instability and even revolutions, as is already happening in a number of emerging market countries. At the same time, however, serious efforts to curb sky-high inflation could trigger a major financial and economic crisis, because the current economic and societal structures have been shaped by many years of ultra-low, that is negative, real interest rates and relentless monetary expansion. This development was possible because the inflationary effects were largely confined to asset markets, and asset price inflation was widely considered acceptable as it allegedly made the economies richer. But things have taken a dramatic turn, as inflation has been reflected in very large increases in consumer goods prices. Public discontent has forced central banks to take action. But the measures taken by monetary policymakers show no strong determination to reduce high inflation by any means necessary or in the shortest time possible. Because the truth is that there is no easy exit from the currently high inflation regime. In fact, the chances that real interest rates, which are deep in the red in most currency areas, will return to positive territory anytime soon are rather slim. In this context, one should not forget that many governments in the Western world are trying to implement the Great Reset, the Great Transformation. Green policy is just one prominent item on the agenda, designed to limit or end people's access to affordable and secure energy supply. It is a political ideology which lowers economic expansion rates, and it aims to roll back or even shut down the free market system or what little is left of it. Debasing the purchasing power of the currency is a proven strategy to discredit the free market system. People become quite disenchanted with capitalism, which they falsely blame for their ordeal, and they turn to politicians and governments for help. Inflation thus is fulfilling its insidious political task, making people increasingly dependent on government handouts, allowing the state to expand its power over all sorts of economic and social affairs of the people, crushing individual liberties and freedoms. Unfortunately, popular resistance to inflationary policy and government's willingness to end inflation are not yet strong enough in many countries. The free society remains under pressure. And while the headline numbers may ease a little further in the coming months, especially as the energy price effect peters out, investors should not conclude that the inflationary regime is over. The debasement of the purchasing power of money will remain one of the top challenges to your financial assets in the years to come. What does it mean for your portfolio selection? In a sky-high inflation regime, it makes sense to minimize your cash holdings to a transaction balance plus a small buffer, because cash will become worth less and less. I still believe it makes much sense to remain invested in the international stock market for the time being. If you are not an experienced stock picker, invest in a globally diversified stock market ETF. I also think it is advisable to hold physical gold and silver. These precious metals can serve as a cash substitute, and their purchasing power cannot be debased by central banks running the electronic printing presses. Moreover, physical gold and silver do not carry a default risk, in sharp contrast to bank deposits. But high inflation is just one reason to hold physical gold and silver. Gold and silver also serve as insurance against the vagaries of the worldwide fiat currency system. Don't forget that all major currencies, the dollar, the euro, the Japanese yen, the Chinese renminbi, and others, are all fiat currencies. And the more the fiat currency standard is pushed to its limits by more and more debt, by lowering the interest rate and accelerating the electronic printing presses, the greater is the risk that something is going to go terribly wrong. Gold and silver would survive any cataclysmic collapse of the unbacked paper money system. Thank you very much for your attention. If you enjoyed the video, please like, share, and follow my channel and ring the bell.